hold on to your seats. I'm going to be giving you a framework to get started in buy-to-let investing in this short video. I'm going to be telling you how to get started, how to pick your area. I'm going to give you a great tip about how to pick up and coming areas so you can really maximize your returns. So point one is goal setting. You need to start with the end in mind. As Stephen Covey said in my favorite personal development book, 7 Habits of Highly Effective People. You need to ask yourself, why are you getting into property? And what are your goals? What are you looking to achieve? Because if you don't have a destination in mind, how do you know whether you've arrived or taken a massive deviation? It's a bit like getting into a car and not putting any coordinates in a sat-nav and just driving. You won't know whether you've actually arrived at your destination. And that is the importance of goal setting. And that is why you need to set out a plan, maybe over a 10-year period, and kind of work backwards from that, and having a set of milestones. So how many properties do you want to buy? How much net income do you want to generate every year? What capital do you need to then meet those goals? That will give you a bit of a roadmap to follow and a structure to then start investing by. And this is the importance of goals, and this is why this is the first point, because it's where you need to start, because without it, you're going to be off on many tangents and getting involved with things that don't necessarily meet your goals, and very much looking at all those shiny pennies that is really easy to get distracted by in property. And this long-term thinking in terms of having that goals planned out over potentially a 10 or maybe more period actually helps you remember that property is a long-term game. It is not a get-rich-quick scheme. It is very much a get-rich-slow scheme. The real wealth from property actually comes over that 30, 40-year period. That is when the gains from capital growth actually take effect. Because property pays you twice. It pays you from the rental income and from the capital appreciation, but you don't get the real benefits of capital appreciation without holding onto a property for maybe a 30 or 40-year period. So that is why you need to combine your goal setting with very much a kind of long-term viewpoint. So capital appreciation is where the real wealth is created, and that is why you need that long-term view. And if you look at the data, property is in fact grown by 3.7% every year since the 1950s, and it is that plus the compounding of that over time that will give you the best benefits of investing in property. Because remember, property, like index funds and stocks, is a long-term investment vehicle. It is not a short-term project. So now we're looking at location, and there are 3 factors to think about when you're picking your location. And if you remember the acronym GSR, then you're onto a good start. So the G stands for goals, the S stands for situation, and the R stands for the ripple effect. So you need to consider each one of these when picking your gold mine area. Now we're going to look at the G, which is for goals, and the importance of linking your area and that decision around that to your goals. And this is why that goal structure that I talked about is so important, because it informs all of the rest of your decisions. So why would you want to look at goals? Well, if, for example, you are thinking about cash flow and how you want to potentially leave your job in 3 to 4 years through accumulation of cash flow and that income which replaces your job, then you're going to want to look at high yielding areas. But for example, if you're thinking more about the long term, you're not bothered about the cash flow and that passive income, then you might just want to look at a capital growth area where you're going to get strong growth over the long term, and you might not be worried about the yields. So that's where goals links to your area of choice. Now looking at your situation, which is the S. And this is firstly about finances. What finance do you have available and what capital do you have available? And that will very much dictate where you look to invest. If you've got loads of money to spend, if you've got $1 million, for example, your choices are a lot more open, and you could look potentially around the south, or you could obviously buy a lot of property in the north. But if you're a bit more limited and you've potentially got only 50 grand, then that's going to really rule out the south, and you're going to have to look towards the north to buy property. So that's why it's important to know what your pipeline of finance is, and that can very much dictate where you invest. Also, in terms of your situation, is how much time have you got to put into this? Is this something you're looking to do yourself? Are you looking to be completely hands-on and take everything under your control? Then you might want to potentially, invest local to you. But if you're willing to outsource everything and you haven't got a lot of time, then it doesn't really matter where you invest in terms of your location. So think about how much time you want to get involved and how much time you have to get involved and how much control you want over the process and how hands-on you want to be involved. The last point here to do with your situation and your goals is, how does your area link to your strategy? So for example, if you're looking to provide quality homes for families, then that's going to dictate what area you go in. Maybe you go slightly in the sort of suburbs, but if you're looking at property for young professionals, then you might want to look towards the city centre, and that's kind of on the more on the micro level rather than on the macro, but again, it's an important consideration to have. If you're enjoying this content, please do like and subscribe to our channel because it really helps us to grow and we really appreciate the support. Thanks very much. Now we're looking at the R, which is the ripple effect, and this is a fantastic concept. The first premise of investing is that you buy low and sell high. Now, as we've already talked about, property is a long-term game and you actually hold, so you wouldn't necessarily look to sell. The concept is there that you buy low and then get the growth, and that's where the investment gains come from. And even if you don't sell, you just refinance and build that equity. That's where the real wealth is created, in that capital growth. Now, how does this relate to the ripple effect? Well, the ripple effect is a way of thinking about this and a way of being able to really maximize your returns by picking the areas that are kind of up and coming or haven't even come up yet, and then getting in there early and then getting the gains that are coming from the growth. So the ripple effect is that. It's the concept of where there is growth in one area, it ripples out into the outer edges of the surrounding cities or towns or even streets, and those start to build and grow and regenerate, and the values go up there. So it is the growth in one area impacting positively the other areas surrounding it. And a great example of this is Manchester. One knows that Manchester has been such a popular investment location over the last sort of 10 years, and it's gone through massive regeneration and investment, including like Salford, for example, where the BBC now live. Prices have gone through the roof, and that means that more investors wanted to get involved and prices have gone up. So some have been pushed out, and now they're looking at the areas surrounding Manchester. So like the Rochdales and the Altrinchams and the Stockports and all of those areas surrounding that, because they've got Manchester postcodes and they're on the vicinity and they're kind of commuter town, those have all benefited as well, and all of those have grown off the back of Manchester's growth. And that is the ripple effect, and that is the importance of understanding it. So when picking your area, you should think about where are the areas that have grown over the last 5 years and where is predicted to grow over the next 5 years. And then maybe you can look at the areas surrounding those, so you can get in there early, because you know that if an area grows or has been growing, then the ripple effect will mean that those areas surrounding it will also grow. So what towns and cities have grown, what even neighborhoods have regenerated or have got lots of investment going on, because you know that the surrounding sort of streets, neighborhoods, towns and cities close to those growth areas will get that growth in the future, and that's something you can benefit from. So remember to use the concept and the acronym of GSR to then help pick your best investment area so you can really maximize your returns. Whoa, I know we've come to the end and I've thrown a lot at you in this video. Just wanted to quickly summarize what we've talked about today and how to get started in buy-to-let. So we've talked about the importance of goals and starting with the end in mind and being strategic and clear on your approach, which will then help inform all other decisions. We then looked at where to and how to pick your investment area and the importance of the GSR concept, so goals, situation, and the ripple effect. In summary, as I've already talked about, it's important to remember that buy-to-let investing and property investing in general is a long game. It takes patience and it takes time. Wealth will come to you if you stick with it over the long term, and the importance of understanding that also property is a business and you need to treat it as such, and you need to be strategic and considered in your approach in order to really unlock the benefits of investing and being able to actually have that wealth creation piece, which we're all in it for. So that's the end of another video, guys. Hope you enjoyed this one. Hope you learned a lot. Please click the like and subscribe buttons. It would really help our channel to grow, and I really appreciate your support. So see you next time. Thanks a lot.